James Bevan manages $10 billion worth of assets at CCLA, where he's Chief Investment Officer. Welcome to the programme. Do you agree with those comments there, that the ECB just doesn't have enough in its armoury to really make much of a difference?
It certainly needs a lot more. And frankly, when one looks at what the Stability Fund will inherit in September when it takes on the mantle of bond market participation, it also isn't going to have enough budget. But I think there are other critical issues that the ECB's rhetoric has yet to come forward in a really punchy way to make investors feel confident that they really mean business.
That's because it's divided, isn't it?
Europe still hasn't grasped the nettle of having a single monetary policy and yet not having a single fiscal policy. And until the federalist agenda is properly addressed, I have to say that the sceptics are going to be out on the euro.
We've had a downgrade in the United States. Can you envisage a downgrade in France, in the UK?
You know, I certainly can. I mean, I look at the UK, we have official government debt figures of 60% of GDP, the Maastricht criteria, they're 75%. If one were to add in the unfunded pension obligations and also the PFI obligations, one probably takes the number up to about 167%. And on that basis, it's very hard to see why the UK should stay AAA if the US does not.
What would happen if there were to be a downgrade then, here in Europe?
You know, what I find really interesting about the US downgrade, looking back at that, is how well flagged it was. I mean, back in April, S&P said, look, guys, actually, if you don't do something pretty quickly, we're going to downgrade. Then in the 14th of July, they came to the table and said, look, we want to see $4 trillion of savings if we're going to keep that AAA rating. Well, you know, we only got $1.5 to $2 trillion of savings, therefore it was always going to be the case S&P would downgrade. Critically, of course, we didn't get Moody's or Fitch downgrading. And I think the real question for investors is, what does a downgrade really mean for the US? Are they going to actually default? And I have to say that the probability of default is next to zero, because after all, the US can devalue its currency, it can print money in a way that sovereign economies within Euroland simply cannot. We cannot have the French saying, look, guys, actually, we want a bit more money, we're going to print some euros, because the ECB at that point will say, no, we're in charge of currency, get back in your box.
US Treasuries, therefore, remain, for that reason, I expect, the safe haven. But for how long, James?
Gee, I have to say that buying US Treasuries at the moment is a fantastic punt in terms of the capacity for the US government to constrain inflation, to continue to have confidence. And after all, if the dollar begins to fall materially, then the material owners who are not US citizens of the US bond market may say, well, actually, we're going to diversify away from US Treasury bonds into other real assets to protect ourselves.
Now, you mentioned inflation there. Do you expect another round of QE in the United States? The Fed will announce maybe something. It'll be very interesting to hear what they say, the tone of words they use, whether they announce something today or not.
Absolutely. Well, we have the Open Market Committee meeting, as you rightly identify, and I think we'll get at least a hint that there will be help for the economy as and when required. And quite frankly, we're still in a deleveraging phase for most of the developed debtor economies, and that will take, I suspect, 2 or 3 more years to work through. The idea that we can get all this sorted by the autumn and get back to business as usual is well wide of the mark.
Yeah, we're now officially in the bear market territory. How should investors be positioning themselves?
Well, I think investors need to think about what they would be selling or what they would be buying. And I think what's really interesting is that whilst we talk about high levels of indebtedness at an economy level or at an individual level, many companies have really very strong balance sheets, net cash, and it may well be that the catalyst for a rally actually are companies saying, actually, we think that you are cheap and we want you because we can have a better business if we buy you. And when companies come to the table with corporate bids, using their own balance sheets in order to be able to buy bigger businesses for tomorrow, you know, it would be very well taken.
You see, that's the key, isn't it? Because there are a lot of companies out there. We've just had the earnings season. Companies not doing brilliantly on the whole, but not too bad. They have a lot of cash, many companies. Many companies
Absolutely.
are very, very strong. So do you think this sell-off is actually warranted because of the fundamentals, or is it emotionally driven?
Well, I think if one thinks about valuation, there are really 2 moving parts. There's what are you prepared to pay to participate in a profit stream, what is the profit stream likely to be? And I have to say that everybody is downgrading what the profits are likely to be. It is very clear that economic growth is much less vibrant than the optimists had us believe. The second question is, what are you prepared to pay, is in part down to the confidence we have in the political system. And frankly, we have seen dysfunctional politics in both the US and Europe. So I can quite understand why there has been a very nervous reaction. That said, if I look at the fundamental free cash flows that many companies are spewing off, I really think there is outstanding value if you are selective in your company selection. After all, there are companies now with lower credit default swaps and higher dividend yields than government debt. I think of companies like Pfizer or Siemens, and I think they are roaring buys at current levels.
With a longer-term view.
Absolutely. Lots of volatility along the way.
James Bevan, always good to talk to you. Thank you very much indeed for joining us here on Bloomberg.